Silver just crashed. $70 to $63 in days. A 14% bloodbath in just 1 month. And if you're watching the news right now, they're telling you the silver bull run is over. They're saying the party's done. Pack it up. Go home. But here's what they're not telling you. While silver dropped 14% this month, 762 million ounces have disappeared from global inventories. That's not a typo. 762 million ounces gone. And the COMEX, the exchange where big banks supposedly have all this silver, they're down to just 86 million deliverable ounces. That's enough to cover about 1 month of global demand. I'm OG Silver Stacker, and in the next 20 minutes, I'm going to show you exactly what's happening behind the scenes, why this crash is actually a gift, and what the smart money is doing right now while everyone else is panicking. Let's dive in. First, let's talk about what just happened. Because if you don't understand the cause, you'll make the wrong decision about what to do next. As of this morning, Friday, June 19th, 2026, silver is trading between $63.90 and $64.75 per ounce. Just 5 days ago, it was over $70. 1 month ago, nearly $75. And earlier this year, we hit an all-time high of $121 per ounce. So, yeah, this hurts. If you bought at the top, you're down almost 50%. I get it. But here's what caused this drop and why it matters. Reason number one, Kevin Warsh and the Federal Reserve. The new Fed chair held rates steady this week at 3.5% to 3.75%. But here's the kicker. He signaled possible rate hikes ahead. Not cuts, hikes. When rates go up, the dollar gets stronger. And when the dollar gets stronger, precious metals usually get hammered in the short term. Why? Because silver doesn't pay interest, bonds do. So traders rotate out of silver and into treasuries. This is Economics 101, and it's temporary. Reason number two, profit taking. Listen, silver went from around $35 in mid-2025 to $121 in early 2026. That's a 245% gain in less than a year. A lot of traders made a lot of money. And when you see the Fed getting hawkish, you take profits. You lock in gains. That selling pressure adds up. Reason number three, geopolitical cooling. Earlier this month, tensions between the US and Iran spiked. Silver surged as a safe haven. Now, things have de-escalated slightly. So some of that fear premium came out of the price. So when you add it all up, hawkish Fed, profit taking after massive gains, reduced geopolitical premium, you get a 14% pullback. But here's the thing. None of these reasons change the fundamental story. None of them address the supply crisis, and none of them explain what's happening in the physical market. So let's talk about that. Here's the number that should terrify anyone betting against silver. 762 million ounces. That's how much silver has been pulled from above ground inventory since 2021. Let me put that in perspective for you. Global silver mine production is about 830 million ounces per year. So in just 5 years, we've burned through almost an entire year of global mining output from stockpiles. Where did it go? Solar panels, electric vehicles, electronics, semiconductors, AI data centers, industrial applications that don't recycle silver. It gets used once and it's gone. Unlike gold, which mostly just sits in vaults and gets recycled into jewelry, silver gets consumed. And we're consuming it faster than we're mining it. How much faster? According to the Silver Institute and Metals Focus, 2026 will mark the 6th consecutive year of supply deficits. This year alone, we're projected to have a shortfall of 46 million ounces. Some analysts say it could be as high as 67 million ounces. 6 years in a row. 6 years of using more than we produce. And here's the scary part. We're running out of the buffer. The strategic stockpiles, the excess inventory, it's almost gone. Think about it like this. Imagine you earn $50,000 a year, but you spend $55,000. For a few years, you drain your savings to cover the difference. But eventually, your savings account hits zero. And then what? That's where we are with silver. The savings account is almost empty. And the industrial demand? It's not slowing down, it's accelerating. The International Energy Agency projects solar installations will double by 2030. Each panel uses about 20 grams of silver. Electric vehicle sales are growing 25% year over year. Each EV uses about 25-50 grams of silver in electronics and batteries. AI? Data centers are being built at record pace. Every server, every chip, every circuit board needs silver. So let me ask you, if we're already in deficit and demand is growing and above ground stocks are nearly depleted, what do you think happens to the price? Now let's talk about the COMEX, because this is where things get really interesting. The COMEX is the Commodities Exchange in New York. It's where big institutions, banks, and traders buy and sell silver futures contracts. and they're supposed to have physical silver backing those contracts. As of June 17th, here are the numbers. Registered silver, 86.2 million ounces. This is silver that's available for immediate delivery. This is the real deal, the stuff that can actually be withdrawn and shipped. Eligible silver, about 235 million ounces. This is silver sitting in COMEX warehouses, but not available for delivery unless the owner decides to make it registered. Total, 321 million ounces. Now, 321 million sounds like a lot, right? Wrong. Global silver demand is over 1.2 billion ounces per year. So the entire COMEX inventory represents about 3 to 4 months of global demand. But remember, only 86 million is actually registered for delivery. That's less than 1 month of industrial demand alone. And here's where it gets wild. There are hundreds of millions of ounces in silver futures, contracts being traded, way more than the physical silver available to deliver. This is called paper silver, contracts that may never be converted to actual metal. But what happens if even a small percentage of those contract holders say, hey, I want my physical silver? You get a short squeeze, a panic, a scramble for physical metal that doesn't exist. We've seen this before in other commodities. Nickel in 2022, palladium, when physical supply runs out, prices don't just go up, they explode. In March 2022, nickel went from $30,000 per ton to $100,000 per ton in 2 days because of a supply squeeze on the London Metal Exchange. They literally had to halt trading. Could that happen with silver? The setup is there. Low registered inventory, massive paper positions, and a structural deficit that's not going away. All it takes is a catalyst. Maybe it's a geopolitical crisis. Maybe it's a major industrial buyer who needs physical delivery. Maybe it's a big bank that decides to take delivery instead of rolling contracts. Whatever it is, when it happens, the people holding physical silver will be the ones smiling. And the people who sold or waited, they'll be paying whatever price the market demands. So while the price is dropping and the headlines are screaming crash, what is the smart money actually doing? Let me show you. JPMorgan, one of the biggest banks in the world, has a 2026 average silver price target of $81 per ounce. Not $60, not $50, $81. And JPMorgan isn't some random YouTube channel making wild predictions. They're conservative. They manage trillions in assets. And they're saying silver is going to $81. Trading economics projects silver could hit $82 to $83 within the next 12 months. Again, these aren't permabulls. These are analysts looking at supply, demand, and market fundamentals. Now let's look at the ETFs, exchange-traded funds like SLV and PSLV. While retail panic sellers are dumping, institutional accumulation has been steady. ETF holdings haven't collapsed. In fact, during dips, we often see inflows, not outflows. Why? Because institutions know something retail doesn't. Volatility is the price you pay for asymmetric upside. Think about the risk reward right now. If you buy silver at $64, what's your downside? Maybe it drops to $60. That's a $4 risk. But what's your upside? If JPMorgan is right and it hits $81, that's a $17 gain. If we get back to the early 2026 highs of $121, that's a $57 gain. Risk $4 to make $17.57. That's what smart money calls a no-brainer. And here's another tell. Premiums on physical silver. Go to APMEX, SD Bullion, JM Bullion right now. Check the premiums on Silver Eagles, Maples, or even generic rounds. They haven't crashed. In many cases, they're still elevated. Why? Because physical buyers know the spot price doesn't reflect the real cost of getting silver in your hands. Dealers are still paying high premiums to acquire inventory. Mints are still struggling to keep up with demand. The paper price says $64. The physical market says, good luck getting it for that. And let's not forget the East. China and India are the 2 largest physical silver markets in the world. Now, when Western prices drop, Eastern buyers back up the truck. Shanghai premiums, the amount Chinese buyers pay above the spot price, have remained strong. They're not scared. They're accumulating. So when you see the price drop and wonder, should I sell? Ask yourself, am I smarter than JPMorgan? Am I seeing something Chinese buyers aren't? Do I know more than the institutions quietly accumulating on every dip? Or am I just reacting emotionally to short-term noise? Let's zoom out for a second. Because if you only focus on the day-to-day price swings, you'll miss the bigger picture. Silver isn't just a speculation. It's not just a hedge against inflation. It's a critical industrial metal in the biggest technological transformation of our lifetimes. The global economy is transitioning to clean energy. Solar is the fastest growing energy source on the planet. And every solar panel requires silver for conductivity. By 2030, solar installations are expected to use over 150 million ounces of silver per year. That's almost 20% of current annual mine production, just for solar. Electric vehicles. By 2030, EVs are projected to make up 60% of new car sales globally. Each vehicle uses silver in battery management systems, charging infrastructure, and power electronics. That's another 90 million ounces per year by 2030. AI and data centers. Every AI model, every data center, every 5G tower uses silver in circuitry and semiconductors. This demand is just beginning. Right now, industrial demand accounts for about 50% of total silver consumption. But as these technologies scale, that percentage is going UP. And here's the kicker. Silver recycling rates are low, around 20%. Why? Because silver is used in such small quantities in each application that it's not economically viable to recycle it. When silver goes into a solar panel or a circuit board, it's gone. It's not coming back into the supply chain. Gold, 90% plus recycling rate. It just gets melted down and reused. Silver, once it's in a product, it's consumed. And on the supply side, primary silver mines that produce silver as their main product, are rare. About 70% of silver comes as a byproduct of copper, lead, and zinc mining. So even if silver prices go to $100, you can't just turn on more silver production. You'd have to mine more copper, more lead, more zinc. And global ore grades are declining. Mines are getting deeper, more expensive, and less productive. Mine production has been essentially flat for years, around 830 million ounces. And it's not growing fast enough to meet demand. So you have declining above-ground stockpiles, structural supply deficits, accelerating industrial demand, limited recycling, flat mine production. What does basic economics say happens in that scenario? Prices go up, not in a straight line, not without volatility. But the long-term trajectory is clear. This isn't hopium. This is supply and demand. And right now, the fundamentals have never been stronger. All right, so here's what you need to do right now. Not next week, not when the price feels right now. Step 1. Stop watching the daily price. Seriously, if you're buying silver for the long-term fundamentals, daily price swings are just noise. They're designed to shake you out. Don't let them. Set price alerts if you want, but stop obsessing over every red candle. Step 2, dollar cost average on dips. If you've got cash on the sideline, use this dip to average down your cost basis. You don't have to go all in at once. Buy some now at $64. If it drops to $60, buy more. If it drops to $58, buy even more. That way, you're building your position without trying to perfectly time the bottom. Step 3, focus on low premium products. Right now, premiums are still elevated. So if you're stacking for weight, go with generic rounds or 10-ounce bars. Save the fancy collectible coins for when premiums normalize. Your goal is ounces in hand, not pretty packaging. Step 4, verify your storage and security. If you're stacking physical, make sure it's secure. Don't post photos of your stack on social media with identifiable backgrounds. Don't tell everyone you know, and if your stack is getting big, consider a safe or secure storage solution. Step 5, educate yourself continuously. Follow the data. Watch COMEX inventories, track ETF flows. Read the Silver Institute reports. Understand what's happening in the industrial sector. The more you know, the less you'll panic when prices drop. Step 6, ignore the noise. Mainstream media doesn't understand silver. They'll call every dip a crash and every rally a bubble. They said silver was done in 2020 when it hit $30. Then it went to $121. They'll say it's done now at $64. And they'll be wrong again. Step 7, join the community. Stack smart, stack safe, and stack with people who understand the fundamentals. That's why I started this channel. To cut through the hype and the fear and focus on what actually matters. So if this video helped you, hit that subscribe button. Join the OG Silver Stacker family. And let's navigate this market together. Look, I'm not going to sit here and tell you silver is going straight to $200 next month. I'm not going to promise you'll get rich overnight. What I will tell you is this. We are living through a once-in-a-generation setup in the silver market. We've never had 6 consecutive years of supply deficits before, not in modern history. We've never had this combination of industrial demand deceleration and physical inventory depletion at the same time. We've never had COMEX registered inventories this low relative to open interest. And we've never had this many world-changing technologies, solar, EVs, AI, 5G, all requiring silver simultaneously. This isn't 2011. This isn't just a monetary hedge play. This is an industrial necessity meeting a supply crisis. Will there be volatility? Absolutely. We just saw it. Will there be more dips? Probably. Will the mainstream media call it a crash every time? You bet. But none of that changes the fundamentals. 762 million ounces gone from stockpiles, 86 million ounces registered at COMEX, 46 to 67 million ounce deficit this year alone. JPMorgan saying $81. Industrial demand growing 8 to 10% annually. So when I see silver at $64, I don't see a crash. I see a gift. I see an opportunity to acquire a critical asset at a discount before the market wakes up to the supply reality. And I see a chance for anyone paying attention right now to position themselves ahead of what's coming. I'm OG Silver Stacker, and I'll be here every step of the way, breaking down the data, cutting through the noise, and helping you stack smart. If you made it this far, drop a comment below. Tell me, are you buying this dip? Are you holding? Or are you still on the fence? Let's talk in the comments. And remember, stack smart, stack safe, and never let short-term noise shake you out of a long-term conviction. I'll see you in the next one.